Good day, everybody, and welcome back. Great to have you with us. And this almost post-COVID-19 restriction time, it's really good to have Alex back in the studio with us. Alex Jamieson from AJFinancialPlanning. How are you, mate?
Good, thanks, Greg. Great to be back here in the studio again.
I agree entirely. Now, people are often asking at the moment, where's the market heading? When they ask you that, how do you respond?
It's a really interesting question, and I think the answer is actually not that important in some regards. It's how you get to the answer. And I'll explain that. So we'll pull up this pie chart, Greg. This is a pie chart of the S&P 500, which is the top 500 companies in the US, and it's by market cap. So it's looking at how big are these companies. Now, if you look at the right side of this graph, what you'll find quite interesting is they're all tech companies. So you've got Google, you've got Microsoft, you've got Facebook. They're all there. Now, that makes up a huge portion. So if these companies increase in value, the market will increase. If these companies don't increase in market cap, not much is going to happen. Now, our Australian, share market is quite different. If we sort of think about our market cap, it's mostly banks, resources, and healthcare. Are they exponential technology? Are they growing fast? Are they doing exciting things? Some healthcare companies are, but, banks and resources are fairly slow and steady organisations. Growth rates of 1%, 2%, 3% is not uncommon in that segment. And I think that's really why, largely, when we sort of look at the differences between our share market and the US one, the market cap is very different in its composition. And that's why also when you sort of look at it and you go, well, how come the share market in the US is so much more progressed upwards than ours? It's because those companies grow at much faster rates of return, and that has a massive impact on things as well. And I think that's really important when someone says, I think the market's going to go up. Really, what are they saying? Are they saying the banks, resources, and healthcare here in Australia is going to go up? Or are they saying, for the US, are these tech companies going to go down? Are they really saying the earnings of these organisations are going to plummet? And that's really the defining aspect I think is really important.
Price-earnings ratios. Some of the commentators are saying that these instruments indicate that the market's currently overvalued. What's your take on that?
I think it's the old statistic things, dirty data in, dirty data out. So when markets are fine, they're very efficient. The flow of information is really efficient. People are able to value them fairly accurately. PE ratios are backwards-looking sort of instruments, and it's looking at that pool. So I always say if you want to write an article that expects the market to fall, you'd pull up the Cape-Shiller ratio. Again, a backwards-looking instrument as well. At the moment, we're seeing huge uncertainties around where earnings for these companies are going to head. People are unsure about the landscape in the next 3 to 6 months. Where's GDP? There's a lot of uncertainty. And so when you're sort of looking at, is the market efficient? No, it's not. And equally, we need to be looking at forward-looking instruments rather than backwards because we're seeing these huge, divergence in earnings. And that's the E and the PE ratio. Our view at the moment is, look, we probably differ from that. We don't feel the market's overstretched. It's still underwater, quite considerably, and we tend to not think that the world will be quite as bad as what everyone's sort of talking about when they're sitting in that sort of camp.
A number of commentators at the moment are talking about October. So what's your view on this with earnings not meeting expectations?
There's two camps out there that are running around. The first camp are saying, look, the bottom's in. And then you've got the second camp, which is, no. The market's run too far, earnings aren't going to meet expectation. And that's really that question around the market composition. When we look at the market composition, we go, are these tech companies going to hit their earnings targets? Or are the individual shares are going to hit our earnings? That's far more interesting. So if we look at this example, this is Amazon. This is the share price of Amazon. The company's trading around 2.5, 2.6 at the moment, USD. The market consensus, their viewpoint is the company's valued at 2,689 based on market consensus. So you'd look at that and say, look, without doing any more further analysis on it, whether are they right? They feel that there's still value in Amazon at these current levels. Now, anyone knows, looking at the share price, it's at new highs since the market sell-off. And generalist sort of comments at the moment probably aren't accurate, whereas very specific questions around, do I think Amazon's overvalued or not, or these individual shares, that's really where that opportunity opens up at the moment. When markets are inefficient, that's where you see those bargains sort of pick up. You see price divergence occur. And I really feel that to some degree that there is still some value in the market. It's just not the whole market altogether. Like any time whenever you're investing, it's picking and choosing what makes sense.
So COVID-19 has seen governments borrow huge amounts of money. So the question then follows, how are they going to pay it back? What's going to happen?
I think the easiest way to describe this is the old analogy with the property developer. How do property developers make their money? Well, typically they'll put 30% deposit down and they'll borrow 70%. As time goes on, the property value grows, and so the ratio drops. And so they're able to borrow more and more, do larger and larger projects. The governments are no different. So the debt to GDP is sort of like the property analogy. It's that ratio. And our debt to GDP here in Australia is quite low. It's below 100%. Places like Japan and US and other places around the world are a lot higher. As long as our debt to GDP, which is like the value of the property, keeps growing, that ratio stays in check. And to some degree, you could continue to borrow money for quite a long distance of time before payback periods ever need to be considered at all, because your ratio could stay at 30% indefinitely if you've got the headline growth. The interesting twist with it, it's kind of like a socialist dream, negative interest rates. You've got the general population now paying your interest bill. And so that really does change the landscape. I think the limits around how much you can borrow are much higher than people ever envisaged. Like Japan's at 200% debt to GDP, they could quite easily get to. And so our capacity as a government, we really can borrow huge sums of money compared to where we are. It's not to say it's a good thing to do. I don't think they'll ever pay it back, though. I think that, like the property developer, there's always going to be debt on the country. But as a ratio, hopefully it will stay reasonably in check.
Is that something that you think's fair, not to try and balance everything again?
Yeah, I think the political cycle around fairness possibly is not leaning that way just because of the election cycle. But in terms of future generations, yeah, there's questions around that. It's going to get more and more difficult once you take monetary policy off the table in terms of the RBA able to drop interest rates. Really, the only lever that they can pull is things like, borrowing more money to stimulate the economy. And so that metrics will become more and more important as time goes on. So you're going to see governments have to spend larger and larger amounts and their balance sheet increases with debt.
So you're saying politically that in the future, it's almost unlikely that it will ever get back to an even playing field again. Is that what you're saying?
I think so. Like if you look at it in dollar figures, the amount of debt will continue to increase. In terms of percentages, though, it will stay relatively the same. And so that's the difference. So if you sort of think of the house value, it's worth $1 million, it's now worth $2 million. You had 50% borrowing on both of those scenarios. You've borrowed a hell of a lot more money, but the ratio stayed the same because your property's appreciated in prices.
So you, at AJ Financial Planning, you don't see that as a worry at all? That's just something that will be part of life?
Yeah, I don't think it'll be a worry for my generation. In terms of the next 20 years. But in terms of future generations down the line, I guess we'll have to watch and see. Until we hit a huge hyperinflation cycle, it's not going to be a problem either. And at this stage with the 10-year government bond, I think pricing in 3 interest rate rises, inflation's pretty much nowhere to be seen. But things can always quickly change. And that would probably be the lever for us to be concerned is if we saw inflation turn back up on our doorstep again.
Well, it's a little more hopeful than I'd actually expected. So I'm sure people are asking these questions everywhere. Well, really, that's all we have time for. But I'd like to leave you with a story today. And this is about a guy who was 34 years of age. This is in 1904. He was a fruit and vegetable merchant. His name was Amedeo Pietro Giannini. And he came from an Italian migrant family, but he was born in San Jose in California. And he got into a shouting match at the bank because they were reluctant to give loans to small borrowers. And it upset him a lot, so much so that he then went and founded his own bank. It's called the Bank of Italy, and this is in San Francisco in 1904. It's the most wonderful story. He became a very successful banker. I believe he also funded Snow White, the first animated film with Walt Disney, and lots of other things after the incredible earthquakes in San Francisco. He was fantastic, and it was handshake. He was straight down the line with his customers and his clients. And in 1921, when he was interviewed, he said this: "Be ready to help people when they need it most, set to yank them out of a hole. The glad hand is all right in sunshine, but it's the helping hand on a dark day that folk will remember for all time." Now, I'm mentioning this story because I've known Alex for a long time now, and I know through this time particularly he has to deal with clients who are going through some very tough times. But I know only too well that he's not only very good financially, he has a great heart and he cares about his clients. So I'm mentioning that story to you. By the way, the Bank of Italy in time, later years, became the Bank of America. That's right. Now with a market cap of $243 billion. That's not a bad story. Be well. Catch you next time. And catch you next time, Alex.
Thanks, Greg.
The advice provided on this program is general advice only. It has been prepared without taking into account your objectives, financial situation, or needs. So before acting on this advice, you should consider the appropriateness of the advice and consult a finance professional. If any products are detailed on this program, you should obtain a product disclosure statement relating to the products and consider its contents before making any decisions. Where quoted, past performance is not indicative of future performance.